I'm Matt Pishar with NAREITWeek.com here in New York City for REITWeek 2015, NAREIT's Investor Forum. Joining me for this CEO Spotlight is Ed Fritsch, President and CEO of Highwoods Properties. Ed, thanks so much for joining us.
Thanks for the opportunity.
Now let's start by talking about office fundamentals and how they're looking in your key markets and how that compares to the national average.
So fundamentals are pretty good right now. It's a good time to be doing what we're doing. I think it's important to say that things aren't robust. Things aren't ramping up at an incline that's uncomfortable and makes you weary of the inevitable bursting of the bubble. It's just been a very nice cadence as we've come out of this recession, and the volume of showings, the level of positive absorption has been steady. The demographics for our footprint are also pretty good for us, so we're thankful for that. As you look at statistics for the South and you look at population growth and GDP and cost of living, quality of life, quality of higher education, it works out pretty favorable not only for our existing customer and prospect base, but also for in-migration. So maybe just a couple of statistics on that. If you look at what's forecasted by Wells for the national GDP for 2015, it's at 2.2. For the South, it's 4.0. If you look at REITs for population growth for the Southeast over the next 3 years, including 15, it's to outpace the national average by 35%. So the South is a pretty big economy. In fact, if you took the GDP of the South and looked at its GDP, we'd rank fourth in the universe, fourth or fifth, depending on how you look at Germany and Europe. So that it's a very big economy, and it's growing at a rapid pace. And the cost of living is an important aspect of that. So there's, outside of DC, there's no city within the South that exceeds 100 on the cost of living scale. And to put that in perspective, here in New York, it's 216. In San Francisco, it's 163, 164. So affordability, high quality of life, and good demographics.
Now switching to acquisitions, you said in your recent earnings call that pricing still remains high, but you kept your guidance unchanged for $50 million to $300 million in deals. What sort of deals are you looking to pull the trigger on?
We're looking at anything that we think might trade. It doesn't necessarily have to be listed, but something that we think might trade, and we study that very carefully, both in the markets that we're in and markets that adjoin us that we might consider expanding into. But exactly right, things are rich, but that doesn't mean we shouldn't be in the hunt. We just need to continue to use our discipline and not put ourselves in a position where we buy something where the underwriting has to work out to be perfection. We think we're good, but we know we're not perfect by any means. And to try and go to sleep at night knowing that you made a significant investment with other people's money and the underwriting has to work out to be perfection is a long, restless night. So we'll pursue things, and hopefully we will get lucky on some of this, and that's why we kept the guidance, because we are looking at things, and we just have to see how that plays out between now and the end of the year.
Of course, the silver lining of high pricing is when you're looking to dispose of assets. How active do you expect to be there, and are there particular regions or types of assets that you're looking to dispose of?
So we've been steady at that as well for the past 10 years, really, in this transformation of our portfolio. Our portfolio is very different than it was 10 years ago. So for us, the criteria is it non-core? And of course, that can be a long definition, but once we identify it to be a non-core asset, we look to sell it. But we have, in the last 10, 12 years, we haven't sold a single asset for the purpose of being able to generate proceeds to satisfy some maturing debt obligation or some other need where we need the monies to deploy it for development or acquisition. We've done it solely because of a strategic move to get rid of the asset and then use those proceeds to do whatever we like to do. So in the timing of those, to us, it's really more, where's the rent roll? So if there's, let's say it's a single user in that building and there's 2.5 years left, but it's a non-core building, we're likely not to put that to market because we're not going to get retail value. So we'll work that until we get the rent roll in a better condition. So what really drives the timing for us, in the most part, is where's the rent roll, and then, of course, where are the macro demographics in the marketplace for putting it to sale.
Ed, thank you so much for joining us.
Thank you for the opportunity. Appreciate it.
For more on this and other REIT news and analysis, be sure to visit REIT.com.